And you've got Anand Rathi, which came out with a pretty solid growth year on year, about 34% in terms of their profit at 57.8 crore rupees. Their AUM growth as well shot up to about 55,000 odd crore rupees. Rakesh Rawal, the CEO of Anand Rathi Wealth, now joining in on the show. Thank you so much for taking time out, Mr. Rawal. Avan, this side. The last time you joined us, you had revised your AUM guidance to about 51,000 crores. And in Q3 itself, you have managed to beat this guidance with a 55,000 crore rupee AUM, as I highlighted. So what's the next target?
Good morning. I think we would say that, okay, we'd like to do 55,000 plus also by the next quarter end, because if the net flows that we might get for the next quarter, we are providing for some market corrections that might happen. So if we end the year with 55,000 crores, I'll be very happy. Well, if the market holds up, then this number could go up. So there's enormous opportunity. And of course, we are hoping for the best.
Enormous opportunity and hoping for the best. Obviously more than 55,000 crores is a possibility. But, in terms of overall, even the profit guidance, that is also at 224 crores is what you'd spoken about. Revenue guidance of 720 crores in FY24. So given all this, is that also something that we could see a revision coming in, or would be better than what you've already guided for in FY24?
Well, we've done about 77% of the annual target in the first 3 quarters. So if we have to do 23% in the balance 1 quarter, logically, there is a chance of an upside. We've not formally revised anything. However, as I said, that the momentum is with us, and there's a very, very good chance that we'll meet these guidances and perhaps try and exceed them.
Always trying to exceed those targets. But Rakesh, what I want your comment on is also the breakup in terms of the equity interest that we are seeing right now, because in our conversation, it seems there's a bit of a FOMO in the tier 3, tier 4 cities. I'm not even talking about the tier 1, tier 2 anymore. I think it's getting a lot more, broad-based and widespread when it comes to the geographical breakup as well. Talk to us about what internals you are witnessing on the ground, and what are you doing to tap into that particular opportunity?
Well, as we've been saying in the past and again, that our strategy of clients' money is based on their objective of trying to get 13 to 14% result, which is got by significantly doing about 65% in mutual funds and the balance in structures. So we have a consistent inflow of money from the clients, right? And we are certainly opening up offices in the tier 2, tier 3 cities. So, for example, we have something in Coimbatore, we have something in Vijayawada, we are doing something in Lucknow now. So I believe that the opportunity is massive all over the country. And by opening up these offices, I think we'll be capturing something in the tier 2 cities and tier 3 cities as well with time. So we don't worry about equity markets. Yeah, I think when you're looking at a 3-4 year kind of scenario, our belief is that the market will be and the economy will be much, much higher than what it is right now. So whether you enter the market at 21,000, 22 or 20, over a long period of time, we have seen that you end up getting 12 to 14% results.
Net flows have also seen a massive surge, 5,400 crore rupees. What is the split between equity, debt, mutual funds, market-linked debentures, etc.? And what is this that indicates about the asset classes that are preferred by investors, according to you?
Well, about 2/3 of this is equity mutual funds, and the balance is structured products and some debt, right? And that's in line with the strategy that we have in place. And so since we are doing just these two, we are getting net flows in these two only. And It's a question of new acquisitions. It's a question of new monies from existing acquisitions. If we are able to tap more of that, this net flow will continue. And we are confident that net flows should continue to do very well over the years.
What did you take regarding the private wealth business in terms of what kind of growth rate should we expect going forward? And overall, what's the differential in terms of the margins of private wealth versus digital wealth?
Well, our belief is that 20 to 25% or 25% thereabout growth in private wealth is going to be there for very, very long periods of time. And the logic for that is that if clients' portfolios grow at 12 to 14%, I just need to add another 10% for getting my 25% number. 10% growth in a, not a well-penetrated market is not a big deal. And therefore, our belief is that 25% growth we should get for long periods of time. As far as digital wealth is concerned, it's an inception business. And it's a very small business, still at an experimental stage. And therefore, comparing margins of the two businesses may not be very fair to both.
You're saying that 20-25% growth is quite doable in the private wealth segment. You
That's
have been doing revenue growth of almost 30-35% in your businesses. How long do you think this is going to continue at the company's consolidated level? Do you think you can replicate this kind of growth come FY25, FY26, or is it going to get better?
Well, our policy has been to be a little bit conservative in terms of giving numbers in the public domain. Like this year also, we started with a number which was close to 20%. And with the team doing well and the markets doing well, we are at a 30-35% kind of number. I don't see why we're going to change that. We are going to be conservative for next year also. And conservative means 20 to 25%. And we will endeavor to do more, obviously. And so far, things have been pretty good.
Thank you so much, for joining in with us, giving us your time this morning as well. It's a pleasure talking to you. That was the management of Anand Rathi Wealth for you all. But